to the first breakout session this morning with the Workplace Savings Breakfast. So specifically designed for trustees of workplace savings schemes in particular, or those involved in workplace savings and restricted schemes. I'm just going to do a little bit of a scene setter now before we hand over to the main event, John Berry. We've got, probably only got about half an hour content around that, so keen to have a little bit of debate, discussion from the floor. If you have no questions, then we finish early. If you have lots of questions, then we'll still finish in plenty of time to get you seated for the plenary for today. Let's say, for those who haven't met me, so I'm David Ireland, Dentons, Kenton Swan, former Chair of Workplace Savings. John Berry from Pathfinder. John will talk a little bit more about himself when he comes up to go through his session. Yes, ESG is it's increasingly the flavour of, it's not the month, it's the flavour of the decade, the past decade of just things keep ramping up. Some of you may have seen or read a really good article from David Chaplin from Business Desk a week ago, where he looked at sort of confused about ESG, sort of you're not the only one going through all the definitions and the concepts and some of the challenges. What does it actually mean? What is it about? John is going to demystify that. I'm the lawyer, so I'm not really about demystifying things. That doesn't get us the money. What instead I want to do is just set a little bit of the scene from the legal framework of what you need to think about from the legal construct for the trustees of workplace savings schemes, just to put that legal context around it before we go to John. Did a similar thing in March when we had Kamal Jalan from Mercer running through ESG. This is a slightly different slant, a bit more of a focus on the demystifying ESG and what it's all about. So sort of 7, I guess, key themes from a legal side, I think, for trustees when considering ESG, SRI type investing, of actually what you need to sort of go through, like your little checklist. And your first thing you need to satisfy yourselves as a trustee is whether or not investing, having an ESG lens over what you're doing, is prudent. Is this the right thing to be doing? Is this am I discharging my prudent person obligation when I embark upon an ESG type strategy? Possibly the better question to ask is, am I investing prudently if I do not have a sustainability ESG lens today, increasingly, given the way that it's starting to dominate thinking and some of the metrics that are now flowing through? Probably a different situation now compared to where it was sort of a decade ago when, with the start of the century, when things were starting to go on, that SRI thing of sustainability was coming through. Is now a very valid thing, I think, for all trustees to at least grasp, even if you decide that's not for you, and need to at least have that consideration as part of your prudent investment approach. You'd look at your trust deed to make sure that you are empowered or not, for some reason, blocked from investing on a sustainable basis. That would be unlikely, but for all things, as a superannuation scheme trustee, your trust deed is your guiding instrument. Always need to start there. What is our basis? What does it say about our trustee powers of investment? We then look at the FMCA, which is where it gets a little bit more interesting perhaps for a workplace savings scheme compared to a normal retail scheme. So the Financial Markets Conduct Act, the key duty you're looking at is our duty to act in the best interests of members. In a retail scheme, of course, the members can decide themselves of choosing, do they want to go sustainable or not, because they can just vote with their feet if they don't like the philosophy of the scheme that they're in. Workplace savings schemes, you have a captive audience that people have got generally just one job. They are stuck with the choice of, or the investment philosophy of the employer scheme that they have gone into, and that will dictate the approach that's going to be taken with their investments. So you have that extra duty as the custodians of your members' money as to the approach that you take. So need to assess, well, am I satisfied that I'm discharging my duty to act in the best interests of my members by adopting an ESG SRI strategy? And if I do, what sort of strategy am I going to adopt? And John will talk through sort of a couple of the options or approaches there in his session. How do you go about finding that out? Do you consult with your members? Do you consult what feedback do you take from the employer sponsor of the scheme as to the approach that is the most appropriate for you? Again, there is no no one correct answer. The only wrong answer or the wrong thing to do is to not grapple with that particular question. Satisfy yourselves as to, yep, this is the right approach in the context of our scheme, and then document that. There are, of course, a number of hard filters that we've got. Not allowed to invest in munitions, cluster bombs, that sort of thing. Our last session we had with the Workplace Savings or the Financial Services Council Connect series back in mid-March was just when Russia had embarked upon their military exercise, and you just started having the Russian filters. So that's, again, is an evolving thing. We're not really going to talk too much about those specifics because that's hard and fast law, but those are things that you just cannot do, but those are negative filters generally under law. Once we've gone through that sort of little exercise, we then look at, from a scheme side, the key structural thing you're looking at is what is in our SIPO. So what have we documented in terms of our strategy? Everything should go back to your SIPO, and you constantly review that to make sure, well, have we got the right setting for our approach to ESG that is documented there. That in turn will flow through to your PDS for your offer for your scheme, and you want to fill out your OMI to detail exactly how we're doing it. Make sure that your whole set of disclosure documentation and your SIPO all read as one, are all consistent, and that you are taking a clear, considered approach with your approach to ESG, so no one is getting confused. You're not going to be accused of greenwashing with the approach you're taking, but equally it's you have your offer documentation set there that anyone can go have a look at what's on the disclosed register, have a look at your website and have a clear picture as to, right, this is what this scheme is about. So the members investing in the scheme, they've got a clear picture as to the approach that the trustees are taking with investing their money. And then last but not least, we have the FMA Guidance, so the 2020 guidance on integrated financial products. That is primarily directed really at your disclosure side of how it is disclosed, but there is some really good analysis or checklist through that to be working through to say, well, if I'm approaching ESG, what are the considerations? What should I have covered off that I should be looking at, documenting that. If not in your PDS, because let's face it, no one's got room to write a full book in your PDS as to how it all goes, but actually how we wrap that around into our OMI and is it consistent with our SIPO, so that it is a very clear picture as to the approach you're taking with ESG. So that's, I guess, a little bit of the scene setter. I'm going to hand over to John, who's going to work through his slides of trying just demystify some of the myths, misconceptions, and other issues to do with all things ESG and sustainable. John, in your hands.
Thank you, David. Kia ora, everyone. Thank you for including me in your breakfast and in your conference. I'm not an expert at workplace savings and restricted schemes, but what I did for some background was spent several frustrating hours on the Disclose website, digging down into some of your schemes and documentation to get a good feel for it. Any of you that have used the Disclose website will know the feeling that that's several hours of your life you're never going to get back again, but it was really good background. So what we're going to cover today, ESG. Important to understand what it is and what it isn't, how investment managers use ESG. It's widely used, it's not very standardised at the moment, and that's creating issues. And then looking at your schemes, how do you adopt ESG? What questions should you be asking fund managers, and what are the risks of both adopting and not adopting ESG approaches? Recently, you will have seen a bit of interesting comment in the media. The Economist ran some stories on ESG. Elon Musk has had a lot to say about ESG being weaponised. A guy called Tarek Fancy, who's the ex-head of sustainable investment at BlackRock, has had interesting comments about the challenges of ESG. What is this all about? Well, essentially, the starting point is to work out what ESG isn't. So ESG is not three words that is going to save the world. ESG is not the same as ethical investing. ESG is not about values at all. So that's the kind of starting point, is to work out what it's not, and then think about what ESG sorry, I'm just having a few slide issues. What ESG is. ESG is simply data. So it is data about the practices and policies of companies in relation to their environmental, social and governance attributes of that company. So essentially for me as a fund manager, it helps me identify better quality companies, better managed companies. It helps me make more money. So it's about value. It's about making money. It's not about values. It's not about ethics. So as a fund manager, for us, it's an integral part of what we do. It helps us manage risk, hopefully generate better returns. A lot of people are cynical. The economist is very cynical. The fund management industry is always looking for the next big fad to make money out of, and there's a lot of cynicism that greenwashing is going on with a lot of managers, and this is just a good way of generating extra fees. And there is, to be fair, some truth in that, a lot of truth in that. Sorry, I'm just having a few issues. Okay, the ESG, if we look at the limitations, just really quickly, availability, methodology and accuracy are the availability, methodology and accuracy are the three challenges. So availability is essentially you can't manage what you're not measuring. And if you look at companies like this week, met with a New Zealand infrastructure company, talking to them about their solar panels. Components for their panels, they're made in the US, but the components come from all around the world. Components will be coming from parts of the world where we're not happy with the labour relations and the way workers are treated. But ESG data on that company is not capturing that part of their supply chain. So data is often not as widely available as what you want it to be. If I think of Fletcher Building, looking at their carbon emissions, they measure their scope 1 and 2 carbon emissions. What I'm really interested in is scope 3 emissions as well, which is not measured. So again, the availability of data is not there, and ESG providers, the data providers, only measure scope 1 and scope 2 emissions. So in terms of in terms of methodology, how things are measured, there's a whole bunch of different providers that provide this data, this ESG data, on thousands and thousands of companies around the world, and they're not consistent. So if you think of the three components, environmental, social and governance, just as a starting point, how would you weight the importance of those three if you're scoring companies? Would you just say a third, a third, a third? Would you say environmental and social is more important? We'll go 40%, 40%, 20% to governance. There's so much discretion around how the scoring works, and then under each of those limbs, like under the S, social, you were talking about suppliers and staff and communities, there might be 150 different metrics there. How do you weight each of those? What are those individual metrics you're measuring? So every provider has a different process. The key thing is to understand what the data is you're getting and how it's calculated, what the methodology is. So I'm going to give the example of ExxonMobil. So it's rated by a whole bunch, no surprise, rated by a whole bunch of ESG providers. Refinitiv give it a score of 71, which is good. So it's a reasonably high score. MSCI have a different scoring system. They say it's BBB, which is average. Sustainalytics give it a score of 36 and they rate it as high risk. And then another company called LobbyMap, they track what companies are doing in the real world as opposed to what they say they're doing in the media. And ExxonMobil, they give it a D rating. They say it is actively trying to stop or slow regulation, climate regulation, to benefit its business, while it's actively in the media saying that it's all about climate change. So who do you believe, or which data source do you want to take on ExxonMobil? You've got the full spectrum there from great to very poor. And in terms of accuracy, is the first two limitations were availability and methodology. The third limitation is accuracy. And essentially here, we can see sometimes data is incomplete. Often data will be estimated. There are thousands and thousands of companies where where an ESG provider can't get the data easily. They will just estimate it based on peers. That caused a real problem for us on carbon data. We were finding with our ESG provider, too much estimation was made, and it was causing us issues. We had to sanitise the data. But essentially, what I'm saying is there are challenges with ESG around the methodology, the accuracy, but it is an integral part of investment management. And in my mind, what you need is a human overview looking at the data and interpreting the data. If you just take the data at face value, you are going to face these anomalies, these issues with the way you invest. So just quickly, some examples, ESG surprises, which is why I think you need a human overlay to help you understand what ESG actually means. S&P 500 ESG index. ExxonMobil is a top 10 holding in that ESG index. Phillips 66, which is an oil refiner, recently got added to the S&P 500 ESG index at the same time as Tesla was kicked out. Like, to most people, that's like, what's going on there? Tesla, on the E factor, is trying to drive change in an entire industry, decarbonise an entire industry. Surely it should be scored highly on the E factor. But it's also had some labour relations issues in its factories. The S factor has some quirky stuff going on with governance and Elon Musk, so scores low on G factors. So the S and the G overrode the E factor. Tesla is out of the index. That would surprise a lot of people that ExxonMobil's in there, but Tesla's not. British American Tobacco, I find this one of the big surprises. Well done to them. 20 consecutive years in the Dow Jones Sustainability Index. British American Tobacco, one of the most sustainable companies in the world. If you use their product as recommended, you will harm your health, you may even kill yourself, but it's still high on ESG scoring. And again, I just mentioned active and passive at the end because I think passive strategies struggle to interpret this data and put a human overlay on it, which is where active management makes a really big difference to make sense of not just what the data is telling you, but what is the company, how is it behaving in the real world. Sorry, I'm just having a few clicker issues. Greenwashing. So what is greenwashing? In my mind, the simple way to think about greenwashing is the marketing department has got 3 steps ahead of the investment team. So essentially, the marketing department see a great story, they want to tell the world about the story, they've just got a little bit too far ahead of what the investment team's actually doing. Another way of thinking about greenwashing is it is the complete opposite of authenticity. And what I want with the companies I invest in and managers I work with is authenticity. Greenwashing's become a big issue offshore. You may have seen in the press DWS, which is a subsidiary of Deutsche Bank, had their offices raided by the German regulator around their ESG claims not matching the reality. Goldman's in the US has run into the same problem. In New Zealand, the FMA has had a focus on greenwashing. And within these walls, I can share with you that we were one of the managers they looked at, our Global Responsibility Fund. We got off very, very well, which is, thank God, because it's what we do as a business. The 2 things they picked us up on were, one, we have on our website that we are a signatory of the UNPRI, and they said to us, but you're not telling your members what the benefit of being a UNPRI signatory is. So, okay, I'll write a blog and put that on our website. But I mention that because I see, when I was looking on my disclosed search, I saw some schemes have in their policies that they will only use managers who are UNPRI signatories. You need to take the next step and say, why? What benefit is that? Second thing we were pulled up on, when I say pulled up on, we were queried about, was we didn't mention how we use derivatives, and can we use derivatives to buy stocks that our ethical policy would not let us buy? To me, that would be, I don't mention it because to me that's just unethical behaviour, but it turns out that that's not uncommon, that some managers in their policy will say we won't invest in fossil fuels, we won't invest, and then they go and buy S&P 500 futures. And so essentially through derivatives, they get exposures to the very companies that they are not supposed to invest in according to their exclusions policy. So I mentioned that again, good question for you to ask managers how they use derivatives. So just moving on to, in this bit we're going to focus on what are good questions for you to ask managers when you're chatting with managers about ESG. I suppose the key thing from your perspective is you need to know the extent that managers are using ESG and why, not just what they're doing, but why are they doing it. And over the next few slides, we'll go through the process of not just ESG, but actually ethical investing, and we'll think about the what and the why for each of those steps. I'm on the board of for a charity for an investment committee, and I get the fun job of actually interviewing the other fund managers, which I absolutely love. We had one in recently, I mentioned Sky City because we had one in recently, and they said we don't take values into account with our investing, and they don't have Sky City in there, which was important for this charity that's not in there. And I asked, why don't you have it in there if you don't take values into account? And they said, it's about social license to operate, that we think Sky City's at risk of losing its license, so we won't invest in it. But you want to be clear, why are people excluding things? Is it on a values basis, or is it on the basis of making more money? Facebook is another really, really good example. I don't think there is any valid ESG basis to hold Facebook in your portfolio, yet every fund manager seems to hold it. We don't hold it. You'll find most fund managers do hold Facebook. If you look at it on a social metric, product addiction, privacy issues, Cambridge Analytica, whole bunch of issues on the social side. On the governance side, you've got Mark Zuckerberg. He has, the last time I checked, has 16% of the equity in the company, but 60% of the governance of the voting rights of the company. So he appoints the board. He decides it's a global media company and one person has complete control of it. On what basis is that good governance? So in my mind, there is no social or governance reason why Facebook should be held in portfolios, but it is widely held. Just ask managers what their view is on Facebook. And I mentioned Mindful Money here as well. This is a really good tool, and this is a tool you may want to share with the members in your schemes. So they can drill down into the various options you offer them in funds, and they can see what stocks are in there that they may regard as harmful to the environment or to society. So it will actually list the companies in every fund. Sorry, I think something's really going wrong with my clicker here. I'm just going to try and go back up a bit. I'm just trying to get us back to exclusions. Here we go. So starting with exclusions, we're going to go through the sort of ethical investment process. The starting point is exclusions, which has sort of been the foundation of ethical or responsible investing in New Zealand. What you really want to understand is the framework that managers use for choosing exclusions. So when I look at a lot of managers, they are just random lists of things like tobacco and gambling, fossil fuels. Like, what is the thought process behind it? Are they linking it to New Zealand law, regulation and conventions, international conventions New Zealand signed up to? That's an entirely valid framework for using. Is there some sort of ethical overlay that they're using? Get them to explain to you how they choose their exclusions. Also get them to talk to you about what does that mean for risk and return. So if you think of exclusions, every time you add an exclusion, you reduce your investable universe. If you reduce your investable universe, you reduce the opportunities that you can invest in. What does that mean for tracking error of the portfolio? Get them to explain that to you. So next step after exclusions is ESG. What you want to be thinking about with fund managers is how do you integrate ESG in the process? And there is not one way of integrating it, there are several ways. For some managers, like Pathfinder, it's absolutely core to what we do. It is right at the start of our investment process, carbon data, ESG data, alongside financial metrics. And then we're optimising for the best portfolio. Some fund managers reverse the process. They will use financial metrics, choose stocks, and then at the end just run a quick ESG overlay. To me, that's, I don't know, that just is like a little marketing addition. You want to get managers to talk through, like when I mentioned the investment committee I'm on, and a manager looked horrified. I was on the committee asking questions. First thing they said is ESG is super important to us, because they knew that's what I wanted to hear. But it was on slide 5 down the bottom right-hand corner was ESG. Like you want to drill down into the authenticity of how are they actually embedding ESG in their process. And also ask the question, is ESG more than exclusions? Some managers treat ESG and exclusions as synonymous. They are not. Exclusions are not ESG. They are something quite different to ESG. Ask, why as a manager are you doing this? Are you doing it on a values basis, like environmental and social metrics, or are you doing it on a risk and return, improved returns basis? And there's really interesting data around risk and return from ESG. That's one, for us, it's really important. We think it helps us generate alpha. We launched our first ethical fund back in 2010, and we have been struggling since then with people saying, get woke, go broke, and we launched our KiwiSaver 3 years ago. Embedding ESG in our KiwiSaver, we've just got our 3-year data. We are the #1 KiwiSaver across conservative, balanced and growth over the last 3 years. So finally we're getting the data to be able to say to people, you can have both an ethical overlay and make money for investors as well. One of the interesting things about ESG is on the drawdown side. So really interesting study by Bank of America in the US over 10 years. If you ignored the bottom half of ESG scoring companies and only invested in the top half, so good companies, well-managed companies, you missed 90% of bankruptcies over 10 years. So quite important data around what that does for drawdowns within a portfolio, the extent to which a portfolio falls when markets are falling. So we're going to move from ESG to... Where should I be pointing this? I'm struggling a bit with, just in front of me. Yay. So beyond ESG, there's a whole bunch of stuff managers can do sort of in the ethical investment journey. The voting, every manager should be voting as a shareholder. And you're going to see in New Zealand, we're a bit behind the curve on voting on shareholder resolutions compared to offshore. Offshore, there are platforms like As You Sow, Share Action, that put forward quite aggressive environmental and social resolutions and then rally people to vote in favour of them. We don't have that in New Zealand yet. I think we're going to see that though, because what happened last week was Sharesies have democratised voting for the 500,000 people they have as customers. So if you have 5 Fletcher Challenge shares or 2 Spark shares, you can now vote those on resolutions. And I think retail investors, for them, this could well wake them up to what it actually means to vote. And when someone puts forward an aggressive environmental or social resolution, they may get some support for it. And we've seen what can happen with ExxonMobil offshore. So a year ago, engine number 1, a hedge fund that had $50 million in ExxonMobil, so a very, very small shareholder in ExxonMobil, got 3 shareholders with renewable energy experience voted onto the ExxonMobil board, to the horror of ExxonMobil's management team, but it was supported by BlackRock, Vanguard and State Street. So as well as voting, ask managers about voting, ask how often they vote against management. On key environmental and social metrics, we vote against management about 50% of the time. So you want to know that they're actually thinking about the way they vote. And also engagement. You want to know that they're talking to companies, particularly New Zealand companies, just encouraging, diving down into supply chains, asking questions around corporate behaviour and operations and how they're embedding climate change into the business. One S&P 500 company, I sat down with the management and they had, very proud that aligned their business with the SDGs. And I'm looking at their business going, but the biggest risk to your business is climate change because you grow stuff, droughts, storms, a whole bunch of issues are going to be hitting you. Where is climate change as an SDG that's important to your business? And so, managers should be asking those questions to get businesses to think deeply about how they're managing themselves. I mentioned here controversy rating. So if you think of ESG data coming from the providers, it's typically scraped from annual reports or quarterly data. So what you're also interested in is making sure that a manager is agile and is reacting to news reports, lawsuits, changes in regulation. And that's essentially what a controversy rating does. So most data providers will give it, and it's essentially telling you immediately something important happens in relation to a company that makes that company higher ESG risk or lower ESG risk. And so it gives you the opportunity to review during your normal cycle of review to take account of an issue. And an example is, the miners in Australia blowing up Aboriginal sites. That suddenly changes the ESG, significantly changes the ESG risk in a company. Within 24 hours, we'd divested that company. But again, you can't just wait on a cycle of quarterly or annual data from ESG providers. So make sure people are using a controversy rating or something equivalent to keep up to date. I've drawn a line there because that's where most managers stop, but there's also stuff below the line that ethical or responsible fund managers can do. The first one is sustainable themes. So I think of exclusions as being very negative and a very, very slow way to change the world. You know, if you think of BP, British Petroleum, back in the 90s they rebranded themselves as BP Beyond Petroleum. They never really pivoted at all beyond petroleum, and they have been excluded from investment portfolios for decades. So exclusions are a really slow way of making change, but they do make change. It just takes a long time. Very hard way to rally people and get people excited and about responsible investing when it's negative. I see sustainable themes as a much more positive approach to ethical investing and a better way of driving change, a better way of getting engagement with investors. So things like availability of water, renewable energy, energy efficiency. So long-term trends that are really important for society, but are also going to make really good money for investors. So we're looking for those long-term trends, those sustainable themes, the intersection of what's good for the planet and communities and what's going to make great money. And impact investing I mentioned on there. Impact investing is essentially investing in private markets. Very hard to do impact investing in public markets. And private companies can be a lot more targeted and purpose-driven in what they're trying to achieve. I think, and you should all be thinking about this for your schemes, I think particularly in the growth strategies for KiwiSaver and for superannuation schemes, there should be access to private markets. Private markets, you get paid more because you don't have the liquidity in a private market. You can't sell the asset tomorrow. But in a growth strategy, it's a long-term time horizon for the investors. So you need to have access to private assets with long-term, better long-term risk-return profiles, and they also can be investments with great impact. You know, some of the stuff we've invested in our KiwiSaver, Lodestone is a solar network being built in New Zealand. They have raised $300 million. They will generate enough power to power Hamilton. So fantastic business that's going to be very profitable for investors, but also going to help New Zealand move towards renewables. Another company called WillAid, which is out of the South Island, they have developed the world's first biodegradable Band-Aid made of merino wool. It biodegrades within 3 months. All Band-Aids and bandages in the world are made of plastic and don't biodegrade. So this is an absolute game changer as a business opportunity, and huge interest out of the US for it, but also from an environmental perspective, every 100,000 Band-Aids they sell is 100,000 bits of plastic that are not going to end up in the environment. So I won't spend too long on this. David touched on Russia and weapons. Just a couple of really interesting ESG examples. We have an ethics committee. We spend hours talking about this stuff. Weapons I find really, really interesting. So particularly in the US with what's happened on the doorstep of Europe, the need for Ukraine to be able to defend itself, the need for democracies to be able to defend themselves. A lot of people are arguing that all weapons companies should be in portfolios because they are protecting democracy and the free world. I struggle with that on a couple of levels. One is when I look at weapons companies, I can't differentiate between weapons used for offence or defence. So I don't want to invest in them. I also take a rather aspirational view to investing, where I talk about investing for the world I want, not the world I have. And the world I want is a much better world with less conflict. So on that basis, we don't invest in weapons. But the discussion's really interesting because it's not cut and dried around weapons. If you think of, the starting point, as David mentioned, is controversial weapons and landmines and nukes, and the conversation's moved on to you've got military weapons and you've got civilian weapons as well. And even in the military weapons space, so if you take out fighter jets, we found a company we're invested in called CAE, which North American company. It develops flight simulators for fighter pilots. And so we spend a lot of time going, is that a weapon? And we've taken it out of our portfolio on the basis that if we won't have the fighter jet in the portfolio, would we want to have the simulators that train the fighter pilots? So we've taken it out. But then you've got other issues like what about the food company that provides the military camps? It's like an endless, mind-blowing experience. You sort of think of weapons as just guns and cannons. It's actually, it's more about software and microchips. It's very, very difficult and complex ethical world at the moment. The other one I'll mention is climate change, and this is a really good test for you to ask fund managers as well. There's a couple of approaches to why you should take climate change into account with the way you invest. So the responsible investment or the UNPRI framework would say, I take climate change into account because I'm a responsible long-term investor. Climate change is a long-term risk. It impacts the risk-return profile of the companies I invest in, stranded assets, they need to pivot their business, so I need to take climate change into account. Another approach is to say climate change is the single biggest challenge to our civilization and the future world we're giving our children. I feel a responsibility to take climate change into account. Or a third option is to answer with both of those. And I think it's an interesting question for you to ask fund managers, why do they take climate change into account? Hopefully they would give option 3, which is both of those, which is recognising the challenge of climate change as well as the financial implications of it. I'm really struggling here. Sorry. Is there like a laptop I can use instead to... Okay, here we go. So we've talked about ESG, we've talked about investment managers and how they use ESG. What we're going to focus on now is how ESG kind of relates to you and your schemes. Yes. You can't ignore ESG. You can't ignore ESG in your restricted schemes or workplace savings schemes. Some of you do. I've been through your offer documents, I've been through your SIPOs. Some of you don't include it in there. You absolutely need to include it in there. In a lot of ways, what you're doing is similar to me. We build PI funds and KiwiSaver for thousands and thousands of investors, but we can only have one value set and only offer one framework within a fund. That's kind of the same for you. You're restricted in terms of what you can offer. You can have different options, but you have to come up with an option, and thousands of people, it won't match perfectly what they want. And it's your responsibility, it's my responsibility as a fund manager to understand what those gaps are between what investors are expecting and wanting and what we're actually giving them. So communication is really, really important. Fiduciary duty as well, sort of David talked about this, sort of understanding risk return, what time horizon is important to you, what value set you want to include in there. Like if your workplace savings scheme is an oil company, you may not see the need to divest fossil fuels, but you may be sort of guided by the employer as much as by the members. In terms of what you should do, I don't run a workplace savings scheme, but if I did, particularly hearing David talk about, it's a sort of closed. Is closed the right word? It's a scheme that people have to come into, and that you give them the options. If I were you, if I were in your position, I would be offering a responsible option and a conventional option. I would be giving investors the choice on which they wanted to jump into, and explain to them what the difference is. If you don't feel comfortable just offering responsible options, you must have a responsible investment policy. Some of the schemes I looked at don't have; they just have a SIPO. You must have a responsible investment policy. There is a KiwiSaver scheme which now has a responsible investment policy and has invested in a bunch of really interesting stuff. In 2018, on their website, they had really clearly, we do not take responsible investing metrics into account with the way we invest. And I respected them for that, because that was transparency for their investors saying, we don't care about this stuff. And that's absolutely fine. And I urge you, if you don't care about this stuff, at least be frank and open about it. And even as your own trustee, duties as a trustee, I think you need to give that communication to your investors. But a better place to be would be actually have a responsible investment policy. Things are changing fast, so you'll be reviewing your managers, I expect, on a periodic basis. Just make sure you don't leave it too long. Managers are changing their processes. Ask them lots of questions about how they're doing things and what's changed around ESG for them. Because when it comes to greenwashing is not just a fund manager problem, it's a problem for you as well. Because if a manager is greenwashing in their PDS, in their communications, that's flowing through to you and to what you're offering people, and it's probably flowing through your communications as well. So greenwashing is as much of a problem for you as it is for the underlying managers. So communicating with members, in my mind, you just need to be really clear on why, what you're doing and why you're doing it. Is it values, is it value, or is it a combination of the two? And how are you doing it? The future of reporting as well is a focus on non-financial metrics as well as financial. So you will have seen carbon coming through. You may want to report on other things in your portfolio to your members around diversity, supply chain. You've just got to make sure you can get data from the underlying fund managers. The underlying fund managers should be reporting on non-financial metrics, maybe voting. Maybe you want to be able to share voting data with your members. So that's kind of me. That's my little overview of ESG. Very happy. What do you want to do, David? Do you want to take questions? What do you?
We've got a couple of questions that have come through. I wonder
Excellent.
whether you want to take a seat and relax. I think we'll
Great.
throw some questions at you. Take your tablet, John.
Oh, thank you. Thanks. This is a remarkable, by the way. You may get bombarded on social media with ads for them, but they are actually quite remarkable.
So that was a plug.
Yeah, that's a plug. Yeah.
Now, as the producer of that tablet, are they a sustainable company? Would you have that company in your portfolio?
They're not. That's not in our portfolio, but I think it's a high growth company. It should be. Yeah.
Right. Yeah, perhaps what might not be is the manufacturer of this thing, but we'll put that away for now. Right. Okay. One comment you made earlier about, I guess, KiwiSaver schemes or PDSs. We found one where they did have that absolute statement re, we don't take responsible investing into account. Of course, that will be driven by the KiwiSaver Act requirement that's this weird, what I think now is an acronym that's sitting there of you must have your statement as to whether or not it's a KiwiSaver scheme, you do take it into account or not. And Dial has shifted on the approach to that, but then you have to have that statement. It's weird that, say, other schemes or other offerings don't have a similar requirement now with where we've moved to, or possibly the one in the KiwiSaver Act is actually, we've moved on and that statement is no longer necessary or should not even be there. It's sort of a roundabout way of getting to one of the most confusing things is actually what are we talking about? You focused a lot, the starting point was ESG and going through ESG, but of course you've also got SRI, you've got straight sustainable investing, ethical investing, responsible investing, impactful investing, all these other things. I mean, is there a magic term that everyone should be adopting, or do they actually mean different things? Because there's a lot of conflation of these different terms. Just wondering if you've got a comment on what is the right terminology? What are we actually talking about here, John?
Yeah, no, look, it's a really good question because we're confused in the industry on what the right terminology is, and if we're confused in the industry, you really feel for investors because they must be even more confused than us. But in my mind, and this is just, there is no right answer, but in my mind, a responsible investment framework follows the UNPRI, and that is using the lens of I'm a responsible long-term investor, what are the risks I should take into account in the long term? I look at a company and I say, do they look after their staff? Not because I care about their staff, but because I think a company that looks after its staff will make more money, it'll be more productive, it'll have lower turnover of staff, fewer sick days. So the responsible lens really looks at a whole bunch of environmental and social metrics, but does it through the perspective of I want to make more money and reduce the risk of my investment portfolio. And that's a valid way of investing, but let's be honest, it's about value, making money. For me, an ethical lens goes a step further than that and says, yes, it's important that we use these metrics to help us make more money, and with our KiwiSaver, we are, like I said, number one, and we're doing that. But at the same time, there's stuff we care about. Like, I care about the social metrics in a company because I just think I want to invest in good companies. I want to invest in companies that look after their staff. I care about companies that are pivoting their business or were solving challenges of climate change or pivoting their business towards a lower carbon future, not just because it makes them lower risk as an investment, but actually I'm quite keen on the world becoming net zero, and as an investor I want to help drive that. So for me the two key terms are responsible and ethical. You've also got green, conscious, SRI, I mean, it's just mind-blowing, to be honest. And
yeah, I would see ESG sitting over the top of all of that, because I mean, you talk about environment, that's green. You talk about social, it's all of those things about the workforce and those sort of issues with youth labour and those sort of things. Governance takes into consideration ethical and those sort of things. So isn't it better to just have that and then everything else falls under that?
yeah, I suppose like with ESG as well, like I look at governance and I go, actually that's just good investing. That's for me, like people should be looking at the governance anyway. But ESG is not about values. So ESG in itself, the whole data that we provided is not a values-based system. It's not debating, should democracies be able to defend themselves with weapons? That's not an ESG question. It's just pure data. So I'd say ESG, yes, it's an important part of investing, but it falls under responsible investing and it falls under ethical investing. But it's really, are you using values or not, for me is the big definer.
Yeah, I think that's where you lose the public.
Oh, absolutely. Absolutely. It's hard.
Trying to explain that to someone.
It's hard. Yeah, totally. But then other people, like I mentioned, other people would say ESG is just exclusions for some people.
Oh, yeah, no,
But it's ethical is an emotional word, right? So responsible is a very objective word. And, when I talk to one of the fund managers at a large bank, KiwiSaver, they say, we love the word responsible, we hate the word ethical, because ethical implies that we're making some value judgments. Well, for me, that's the whole point. But they like responsible because it's more objective and just doesn't feel like anyone's making any judgments. But you're right, it's incredibly confusing. The CFFC, Commission for Financial Capability, is trying at the moment and good on them for trying to come up with some terms that the industry would be able to agree on, and they've just done a little bit of work around that. But it's if we don't do it soon, we are going to have a major problem. Something like impact investing, for me, impact investing has a really powerful meaning. It is investing in companies where you can measure the change they're making. So it's intentionally doing that. The change is additional to what would have happened anyway. So if I go and invest in a renewable energy company listed on the New Zealand Stock Exchange, I'm just buying securities in the secondary market. I haven't driven any real world change at all. I've just bought a good company, but I haven't driven change. If I invest in a renewable energy company that's a private company that couldn't get capital for anywhere else, I am driving change. I am providing capital to that private company to make something happen that wouldn't have happened otherwise. I can then measure the benefit that company creates through renewable energy, and I can say, as an investor, I've helped drive that. That, for me, is what impact investing is. Unfortunately, when we talk about greenwashing, impact is a really powerful word for investors, and we will see the industry use impact more broadly with what is really just ESG investing, because it makes great marketing.
It's so much like you've got a whole series of sort of Venn diagrams, little circles, some of them overlap, but it's all this little mess. And then there's a great overarching, which is not probably ESG, it might be, say, integrated financial products, or IFP. IFP is the buzzword not a buzzword, but the term that FMA has applied to all of these things, and possibly you now start to understand why they've gone down that route, because it doesn't mean anything to lay people, but it's a broad term that can cover all levels of an integrated consideration of what you're thinking about. And I don't like it personally, but because it's not relatable, but possibly that is the basket we're looking at. I think one thing for like trustees of super schemes is to make sure that whatever term you're using, you actually need to clarify. You can't just say, well, we're taking an ethical investing approach. You actually need to drill down and say, well, this is what we mean by ethical, this is our focus, and this is what we're doing, yeah? Going through from that. A couple of questions come through from the floor. I'll start off with probably a broader one, sort of to lay observers, consumers. What do you think this is going to look like? We're going to be looking to offer in the ESG space in sort of 5, 10, 20 years' time. We've moved a hell of a long way from even the last 5 years, let alone 10 years ago. You track forward. What do you think? The trajectory we're on, is this just going to keep becoming more and more mainstream to the point that everyone is ESGing or IFPing, whatever you want to call it, or do you think we reach a plateau? What do you see for ethical investing? We already have.
Well, I suppose one starting point is just to say I think choice is really good for consumers, and so if fund managers don't have responsible investment metrics and don't care about it, for me that's absolutely fine that they offer that product. As long as there's transparency around it, investors should be able to invest in that if that's what they want. And the other extreme, highly ethical product. And so there's this full suite in the market, and if investors have transparency, they will drive the change they want. And if we think about where we're heading, let's look where we've come from. We launched our first ethical fund in 2010. And when I went to financial advisors, our distribution was through financial advisors. Most advisors in the country said, I've got one nutcase greenie, tree-hugging client that will be interested in this. I'm not showing it to anyone else. And so every, out of, 100 clients or a financial advisor has, they have one person who would be interested in it. And then we moved to 2016 when Kiwis found they had landmines and nukes in their KiwiSaver. So suddenly exclusions got on the radar back in 2016, so that's 6 years ago. And then ESG has been embedded in the way we invest. Where we're heading, I believe where we're heading is just a wider offering of ethical product. So I think investors are caring more and more deeply about ethical investing. They just need to help understanding the options. And impact investing, I think I'd love to see the large banks get involved in impact investing. In KiwiSaver we have $85 billion. If 1% of that was invested in impact investing, so it's not philanthropy. You're trying to generate a financial return. We're invested in 3 social housing projects. They pay a market rate of return, but they're driving change within society. I want to see the banks get involved in that, and I think that will happen. I think it's going to have to be driven by consumers though, so it's just going to take time.
Right, thanks. Thanks for that outline. It's clear, just incredible how far we've come and where it's going now. One of the things I found really interesting early in your presentation, you talked about the different metrics of the way different rating agencies might assess different funds, like your Exxon Mobil, really high and then down depending on the criteria or whatever criteria they apply, which is perhaps something that you don't naturally think about as say a super scheme trustees embarking upon an ESG, whatever you want to call it, journey. You say, right, I want to be ethical, but then one of the challenges for you as trustees is then, how do we measure how well our fund managers are going? What are they reporting on? And do you have let's think, is there in your mind a gold standard of the ratings, or is it actually you need to pick your horses for courses as to how you're going to measure what's the right word? The responsibility index or level or performance of your particular fund. I'm just keen for you to unpack a little bit more about how that works.
No, really good question, because if you look at rating agencies, S&P, Fitch and Dow Jones, when they're rating companies on financial metrics, really, really high correlation in their ratings, really, really tight together. You look at the ratings of ESG, much more widely dispersed. So we use 3 data providers for our ESG, and we, through understanding the methodology, we look at some and go, these are really good on quant-based measures, some are really good on qualitative-based measures. And so for us, this is why I think active management's really important in this space, is don't just take a data stream and invest in it, actually try and interpret what the data means. There is no simple answer other than, there's a lot of research around how widely dispersed the ESG scoring is, but you just need to understand why. It doesn't mean one's wrong, it just means the methodology is different.
So do you report all 3 of those to your investors? So is that plugged up on your disclosed register, and what's that?
Do we report that? No, we use that in our investment process, in our underlying investment process, to help us rate the different ESG-ness of companies. But something like, think of Johnson & Johnson. So we didn't invest in Johnson & Johnson from 2017 when we found we essentially treated them like a tobacco company, and that talcum powder, senior executives realised the connection between talcum powder and cervical cancer, but they continued to sell the product. And for us, that's like that suddenly on a S factor becomes uninvestable. But that won't necessarily be picked up in the overall score. That's just one metric of many within an ESG score. So, Johnson & Johnson is probably a very high ESG company, but for us, that was really important, that they were selling a product that they knew had links to cancer. And you can justify withdrawing it on taking out of the portfolio on two reasons. One is ethically, I think it's appalling that the executives knew this risk, but also financially, a wave of lawsuits coming in the US. They now have 100,000 lawsuits in the US. On this point, the financial damages will be huge. So you can argue as well on a financial perspective, they're going to be tied up for years in lawsuits in the US. It was a good decision to divest it years ago.
Yeah, interesting. Something that perhaps whether, scheme trustees or the investment consultants going through it, have they thought about those sorts of things? When you're selecting your manager, do you know how they are taking into account those things? But I was thinking when you're going through a fund manager duty parade of going through it, are you drilling behind? Say, well, actually, if the manager is approaching it on an SRI, we're a responsible investment house. Actually, you need to understand, well, what are their metrics? What are they actually using to determine that? Yeah. And really sort of unpicking, lifting up the rocks and seeing what's underneath, and actually fully understanding if you're going to go down. And increasingly, that file, and particularly with, say, the FMA's review that it came out on IFP products, etc., it's almost if you're going to be on this ethical ESG journey, you need to go full noise. That's sort of it. So you can't just dip your toes and pretend, because as soon as you start with saying we're going responsible, you're on slippery slope is the wrong word, because that sounds bad when you get to the end, but it's actually you're committed. You've got to go fairly full noise and fully understand what does this mean, and both disclose it to your members as well.
Yeah, no, I'd actually say, David, it goes a step further in terms of it's actually really easy to create a investment product that's sustainable or ethical or green. It's not hard, right, to create it. But for me, the authenticity is around, are you then prepared to put those principles into your business? And does that authenticity not just sit at the product level, but does it go right through the business? Because authenticity is more than just about product. So I'd encourage you to, talk to fund managers about their business and how they run their business as much as the product that they're offering.
Right. Just actually, while we're still on that point, this question just come through. So just points to note. So data providers do change their methodology periodically, and so supporting a need for a human element to interpret it and keep on top of it. Just how ethical a fund is can be referred to as sort of the ethical intensity of a fund. So it's a little bit ethical versus a lot, and then that might change. Yeah, I think that's just an observation or a comment from audience. Thank you. How should we, or how should trustees be thinking about skewing risk? The example given here was overweight to tech, etc., and then explaining this to members, in the ESG context, is sort of, is your ESG-ness, is it skewed towards green? Is it skewed towards something else? And then, is that a valid thing, you think, for trustees to think about when they're going and looking at these funds, of actually looking at the skew, the overweight, in terms of particular factors?
Yeah, no, it's a really good question, because if I talk about our portfolio construction at a really high level, we start with the universe, we apply our exclusions, then with what we're left with, we're essentially trying to optimise a portfolio for the lowest carbon footprint, the highest ESG score, and then all the other financial factors like momentum, dividend, small cap, large cap bias, geography, sector. So all those constraints, we try and optimise our portfolio. If we didn't put constraints around, for example, geography and sector, all our money would be in Scandinavia and as a geography, and all our money would be in technology as an industry, because they're low carbon, high social and governance factors. So you've got to constrain your portfolio and say, there are industries that are high carbon or low ESG, I'm going to take the best player out of that industry. But it's really important, because you're building a portfolio that has to, in some way, have a relationship with market returns. You can't just be all in tech. You can't just be all in Sweden. So we're really mindful of putting constraints around how we invest to build the portfolio that will adequately behave like other Kiwi savers, hopefully outperform. But I don't know if that answers your question, but it's essentially you need to know how far a manager is prepared to go to impacting on their tracking error. in relation to market.
One of these things, and you raised it earlier, it's just come through a question from the floor, you mentioned controversy ratings, right, and as a thing. So that is actually, somebody sort of runs a controversy rating, and I just wonder if you can unpack a little bit more about how that one works. Let's think. The questions come through referencing Sustainalytics, but does it encompass sort of other ratings, and how does it work? How does controversy ratings work?
Okay. I suppose the starting point with ESG is you can get ESG scores for free if you go on Yahoo Finance. So for any company, Facebook, anyone, you can go on Yahoo Finance, you'll get the number. Now that's a single number. That won't really tell you a lot about the company. You actually need the underlying data. So you go and subscribe to one of the providers, which could be Refinitiv or Sustainalytics. You pay a lot of money, you get their basic package, which will give you ESG information. You may want to know the revenue sources for companies. So you pay a bit more money to get a breakdown down to 5% revenue for, are their weapons revenue, is their fossil fuel revenue for all these companies. You pay some more money, you get the controversy rating, which is another service. So it's essentially, you can buy the basic version and then you add all these other things onto it. But the controversy rating, I think, is offered by a number of providers. And it essentially is, news flashes if something has changed about a company.
Right, and it's not. It seems like there's quite a subjective element in a controversy rating, yeah?
Yeah, but with all of ESG, there's a subjective element. Like if you, in the G factor, how do you value board diversity relative to having independent members on your board, which you're going to give a high score to, and how are you going to score those? So there's, that comes back to methodology, understanding the underlying methodology.
Cool. I think probably understanding the underlying methodology might be a good point to wrap up the discussion, unless there's any last-minute burning questions that somebody wants to raise direct from the floor and not go through the app. It's been fascinating running through. Thank you, John, of sort of walking us through the challenges. You've possibly thrown up more questions or more work to do from this of what you have looked at. And the point is, it is not straightforward, right? That there are a lot of considerations, and probably from trustees of superannuation schemes, workplace savings schemes, of looking at that. It isn't, what's come through clear to me is it's not just as simple as saying, yep, we like the sustainability concept, we want a piece of that, and sort of go forth. It's actually, you need to really understand what it is you are wanting to achieve, what makes sense. There are trade-offs with everything, but you need to actually get down, analyse it yourself, what makes sense in the context of your scheme, be very clear about what you're trying to achieve and realistic about what you probably cannot achieve, and just have a good, clear process that you're thinking through and going through it in that methodical, thoughtful manner, as opposed to just jumping up and doing it. Life does not get any simpler for anyone, but hopefully that has helped people just, I guess, understand some of the challenges that are around and got some good strategies as to how you might move forward to take advantage of what we have heard from John this morning. So you just join me in thanking John for sharing his knowledge.